Well, guys, we've entered the last month of the year, the month that, according to all the historical narratives based on past cycles, was supposed to be the explosive climax of this bull market. But instead, reality woke us up abruptly. Midnight. While most of us were sleeping, Bitcoin took a sharp, almost surgical 5% drop, a move that brought the price back down to around 86,000. And it pushed the total market cap back below the psychological threshold of $3 trillion. Let's look at the numbers that really matter. Last week's gains? Completely wiped out last night. For the month, we're painfully in the red, down 21%. And for the year, which is the figure that really makes you think, we're at minus 10%. The current trend is simply incomprehensible for anyone who still thinks with the old ways. 2025, the post-halving year, doesn't look anything like 2021, let alone 2017. We haven't seen the explosive performance we were expecting. I want to be extremely clear. Trying to find a pattern in the past to predict something that will happen in December has become a pointless exercise. The cycles, as we knew them, are now broken. Let's get straight to the point. Why? That sudden crash, right at the stroke of midnight, was not a coincidence. Technically, we're in a void zone between the resistance at $100,000 and the distance support at $74,000. But tonight's trigger isn't technical, it's macroeconomic, and it comes from the other side of the world, Japan. There was a sudden and historic spike in interest rates on Japanese 10-year bonds, which went from 0 to 1.86%. The highest level since 2008. Why does this devastate the markets? Crypto? Because of what's called the yen carry trade. I'll keep it short. For years, Japan offered money at zero cost. Global speculators would borrow yen without paying interest and pour it into high-risk, high-yield assets. Which assets? Crypto and American tech stocks. It was easy money. Now that rates in Japan are rising, this flow is reversing. The tap is being shut off, and speculative capital could start flowing out of risky markets to return to Japan. That was the trigger last night. The irony is cruel. Many traders were positioned long, using leverage, expecting a euphoric start to December, since today officially marks the end of quantitative tightening in the United States. They were expecting a celebration for the end of the restrictive policy in the US, but they were hit by the Japanese tightening. The result? Cascade liquidations and margin calls. If we add the usual FUD from China, which is once again threatening stablecoins to push their own state digital currency, the macro picture from the East this morning is definitely heavy. Despite the short-term panic, we need to look at the signals. But from a long-term perspective, the 30 historical peak indicators remain stuck at zero. And there's a key metric that I keep monitoring: exchange flows. The outflow train continues. In the last 30 days, about 39,000 net bitcoins have left the exchanges. Let's do a quick calculation, because it's important to understand the magnitude of this phenomenon. At this rate of almost 40,000 being withdrawn, at this rate of Bitcoin leaving exchanges each month, the current reserves on exchanges would be completely depleted in 52 months. It sounds like a lot. That's more than 4 years. That would mean not even making it to 2030 before there are no more liquid Bitcoins available on the market. Obviously, that's an impossible scenario. What happens before they run out? If the demand persists, does the price skyrocket? It skyrockets. People always underestimate the long-term impact. And what does demand depend on? On liquidity. That's why expectations for an interest rate cut by the Fed on December 10th are crucial, and now they've shot up to 87%. This is the potential fuel that could meet an ever-shrinking supply. While we're looking at the fundamentals, a real financial war is taking place, and the main battlefield. The number one target of the FUD is MicroStrategy. There's a massive operation underway to spread fear around MicroStrategy. There's obsessive talk about the proposed change to the MSCI index policy, one of the most important equity index managers, which wants to exclude companies with more than 50% of their assets in crypto. This would directly impact MicroStrategy. To me, this looks like an outright attack, a financial war strategy from traditional finance. JP Morgan wants to compete, wants to launch bonds based on Bitcoin. They have every interest in buying Bitcoin at low prices and discrediting the dominant player in the sector. Strategies. We need to stay clear-headed, my friends. I have 3 points to make. First, there's no guarantee that this exclusion will actually happen. The final decision is on January 15th. Second, even if it's excluded from the indexes, MicroStrategy wouldn't automatically fail. The immediate impact would be on MicroStrategy stock, not directly on Bitcoin. Of course, the CEO admitted that if the stock crashes below NAV, they might sell Bitcoin, but only as a last resort. We're talking about hypothetical second and third level consequences. This is pure financial speculation that distracts us from the real fundamentals. The same goes for the recurring FUD about Tether. Despite fears of insolvency, historical data analyzed by Willy Woo shows that Tether withstood a bank run, withdrawals of 20 to 25% in 2022 without batting an eye, while traditional banks like Silicon Valley Bank collapsed over much, much less. Now I want to talk to you about the most important thing this week, the topic that unfortunately only a few care about, but that will change everything. The technical fundamentals. While the market is obsessed with Bitcoin's price and JP Morgan's moves, the day after tomorrow, December 3rd, Fusaka is coming to Ethereum. In my opinion, it's one of the most significant updates in the history of the sector. We need to understand one thing. If mass adoption hasn't happened yet, it's because the technology wasn't ready. Fusaka changes the rules of the game on 2 crucial fronts. Extreme scalability. Layer 2s will cost even less. If today we pay a cent, we'll pay less than a cent. They'll be faster, and the network will be faster. 2. User experience, guys. And here's the real revolution that everyone underestimates. Fusaka introduces native support for the encryption keys we already use on our phones. Passkey. Let me translate. We could finally sign on-chain transactions using our biometric transactions directly from our phones in a secure way, and thanks to native integration at extremely low costs. It might not seem intuitive, but it's incredibly powerful. This breaks down the biggest barrier in Web3, the complexity of wallets and managing private keys. We'll see decentralized applications, maybe using stablecoins. Think about Sony, for example, which just announced its stablecoin based on WebM that are as easy to use as a centralized banking app. This definitively bridges the gap between CeFi and DeFi and is the fundamental basis for mass adoption. Bitcoin has its digital gold narrative, but Ethereum thrives only if its virtual machine is actually used. And guys, we're about to get a real taste of true Web3. What am I trying to tell you with all this, guys? That, despite the market's ups and downs, the overnight drop caused by the Japanese yen, and the fear generated by financial wars and counter strategies, this sector keeps producing real, tangible innovation. The technological fundamentals have never been so promising, yet they're still highly undervalued because people pay more attention to the noise than to the signal. Guys, this is the way, as you well know, that I do market analysis. I objectively look at both technical analysis and the macro side, never forgetting the technological fundamentals, which are the only real reason this sector exists and will keep growing. Okay, I hope you like this approach. If you want me to bring this in-depth analysis once a month, just let me know. Alright, give me a like and write in the comments. Okay, I'll see you in the next video. Bye!